Hello everybody and welcome. This is Chande. Welcome to a discussion of the TrendSpider use case showing how we could analyze a trend break in the S&P 500 that started in early April of 2024. A gentle reminder, there's risk of loss in trading and past performance is not necessarily indicative of future results. This is daily data of the S&P 500 index. This is the arch indicator or the adaptive regression channel indicator. We pushed it back 5 days to clarify the breakout, and we've used 50 days as a default length for the calculation. The inner bands are plus and minus 1 standard deviation. The outer bands are plus or minus 2.5 standard deviations. So during the uptrend, you see we had support in the general neighborhood of the lower band and resistance at the general neighborhood of the upper band. On the 4th of April, we had the first decisive close below the band. If you can imagine an imaginary extension of the bottom trend line, you see that we went up and retested the bottom of the channel, as typically happens. And then when we had the hot inflation report, the market sold off quite strongly. So let's apply some of the other tools in the toolbox to understand the current state of play. Here we have a larger view or a longer view of the 50-day channel that we had in the previous slide. And in the lower panel, we have the CHATS indicator. CHATS measures the trend strength. That's the Chande absolute trend strength indicator. And you see during the uptrend, we had values at or close to 100. And for the first time now, we have the CHATS indicator falling below 70. So generally, below 70 means that we are entering a neutral area or a consolidation. We continue our analysis by plotting a 100-day arch indicator trend channel, again pushed 5 days back. And the interplay between the channel and the CHATS indicator is a little clearer. You see that when the market was trending steadily higher, the CHATS value was mostly in the green region. When we had little minor sell-offs, we had values drop below 70, a little weakness value below 70. But this is the first time where not only do we have a value below 70, approaching 50 actually, but we also have a decisive break below the trend line. So as a trader, you'd have to pay attention. We continue our analysis using the arch indicator on daily data by extending the channel to 125 days and also bringing it up to date to the most recent bar. So just at a quick glance, you can see that we had a decline below this channel before the market rebounded, and we are now right at this longer term channel. So we are clearly at a critical point where the market has to decide what it wants to do, whether it wants to keep going higher or trend lower to consolidate further. So using a trailing stop allows us to focus on what's happening to the trend rather than worrying about what will happen next. So here we have applied the PALS indicator, which is the parabolic accelerating long stop with a default speed of 1. So for example, when we had the long entry here, we got stopped out on this little consolidation. If you went back in, say over there, you'd have been stopped out over there. And suppose you went in long, now you'd be following this trend higher. And until the market comes down and hits this trailing stop, by default, we'll assume that the trend is still up. Here we have the TC Blast indicator. The first entry came after weakness in October, and you would have entered somewhere here or there. After that, the trailing stop would have knocked us out over here. A re-entry in early January would have taken us all the way to the present moment. We were barely below the trailing stop there, but potentially you could wait to see whether the most recent value would be hit. So we're within maybe a day or two of getting stopped out if you're not stopped out already based on exactly how you set up the trade. Here we're applying the FEMA indicator, or the fully adaptive moving average, using only default values. The bands here are 100-day ATR or average true range bands. We had a breakout in late October, early November, and then the prices slowly kept going higher, and we've not really had a move below the lower band like we had here or there. So currently, if you're using this indicator, you'd be waiting for a close or a low or a move or a couple of candles at least below the lower band to confirm that there has been a change in trend. Of course, I don't know exactly what the market is going to do. Clearly, if it makes a new high, the analysis will have to restart. I've used the normal Fibonacci pullback region of say 38% to 62%, and that would be a decline of say -4% to -7%, which is very typical during uptrends and would not radically change the uptrend. If you're looking for a deeper pullback, it could come down to the January lows, which would be a reasonable Fibonacci pullback if you went back all the way to the October lows, and that would be about 11% pullback. So these are just reference numbers to calibrate uh, declines that would be consistent with historical market action. All the tools I've used are available at TrendSpider.com. I hope you like and subscribe, and thank you for listening.